Well, good morning. We're going to talk this morning for a little bit about something that actually is not new in the world, but may be new to you. And that's the fact that there is a right way and a wrong way to prepay a mortgage. And every time that I have presented this information, there are always people that are confused. So I'm going to do my best to simplify it and make it clear. In order to understand what we're talking about, you have to get your head around the fact that a mortgage loan is different than any other kind of borrowing. Most of us are used to thinking about mortgages or loans in terms of credit cards, car loans, bank loans, what is called revolving credit, where every month the bank calculates the interest that's due for the last 30 days, and you get billed for that interest or for that interest in some minimum payment of principal. But a mortgage is not like that. A mortgage is a contract with a lender that has a fixed amortization schedule attached to it. In other words, when you take out a mortgage loan, you know on day one what each of the 360 payments is going to be and how much of each payment is principal and how much is interest. It's really important to understand that in order to understand the difference between proper prepayment and incorrect prepayment. All right, let's take a look then at a loan amortization schedule. That's the best way to get a handle on what I'm talking about. I can email each one of you an amortization schedule generator if you'd like to have that in your computer file. Just send me an email and ask me for it and I'll send it back, or I can send it out. I think I'll have a record of the people that are online with us now. But this is an example of a $250,000 loan at 5% interest for 30 years. And you can see that it's calculated that the monthly debt service is $1,342.05. And if you look down the payment column, that stays the same every single month. But within that payment, the part that's principal and the part that's interest changes every month. And the reason is, if you look at this first payment, you start with the loan balance of $250,000. You make the required monthly payment. And of that, it takes $1,041.61 to pay the interest for the prior 30 days on that loan balance. And out of the $1,342.05, that leaves $339 left to reduce the principal. So after you make payment number one, the loan balance then is $249,699.61, and that is the beginning balance for month two. In the second payment, you're not paying interest on $250,000 anymore. The balance has gone down a little tiny bit, so the interest is a little tiny less, so the principal is a little tiny more. And that goes on throughout the life of the loan. And this animal that we call a home mortgage, if you want to get technical about it, what it's called is a level payment, fixed rate, 30-year, self-amortizing mortgage loan. What do we mean by that? Level payment means the payment stays the same throughout the whole life of the loan. Fixed rate means the rate does not change. Self-amortizing means that this loan eventually pays itself off such that when you make the very last payment, the principal is reduced to zero. And mortgage loan means that it's a loan secured by real estate. Now, this is an oversimplified graph of what that mortgage might look like. Each one of those blue stripes represents a monthly payment. And if I could draw thin enough lines, I could draw 360 of those, because in a 30-year mortgage with 12 payments a year, you have 360 payments. They would all be the same size, but they would differ, each one, as to how much of the payment is interest and how much is principal. And this curve that you see on this graph is an approximation of the loan payback line for a self-amortizing 30-year loan. And you'll notice that that line is not straight. That's on purpose. It's not supposed to be straight. It's designed by bankers to work for bankers and to work in their favor. In fact, with the way this curve is shaped, you can pay on a 30-year mortgage for 20 years and you still owe 50% of what you borrowed. Say what? Yes, that's correct. If you look in the amortization schedule out for 20 times 12 would be payment 240, you'll see that the balance is still 126,530. You still owe more than 50% of the principal after paying for 20 years. In fact, if we go on out to payment 270, you can see that after making 75% of all payments, you still owe 40% of the principal. Again, this animal is created by bankers for bankers. It's designed to work in favor of the bank. I don't know about you, but I haven't walked into any branch banks lately where it looked old and beat up and the furniture looked used and scratched. Banks make a lot of money. Don't kid yourself. They make a lot of money and they don't take as much risk as they make you believe that they do. Now, if you were to make this same payment every month, the next question I want to pose is, does it matter where you are in the mortgage? Does it matter if you're at the front of the mortgage or the back of the mortgage? Well, let's take a look. Let's say this first blue line represents payment number 10, maybe. That blue line represents how much of the $1,342 is interest, and the yellow represents how much is principal. Now, if we go out to payment maybe 300, you'll see that there's the same payments, the same size, the same 1342.05, but much less of it is interest and much more of it is principal. It does matter where you are in your mortgage. In fact, the last time I thought about refinancing my mortgage, rates had dropped. I'd been paying on that loan for a good while, but I was really attracted by the lower interest rate. And luckily, I had an honest mortgage broker that was a friend that was helping me. And she looked at my mortgage and said, no, Norman, you don't want to refinance. Even though the rate is lower and the payment would be somewhat lower, you're far enough into this loan that you're actually killing off a lot of principal with each payment. If you refinance, you're starting back over here at zero. Can you folks see my mouse? Is that visible to you? I'm circling it the front. Okay, you can't see it.
Yes, I can see it.
Okay.
I can see it as well.
All right. Well, here's what happens. See, when you refinance, maybe you're out here killing off some principal. You refinance, you might get a lower payment, but you're starting back at the very beginning where the payment is almost all interest, which accrues to the benefit of the bank, not you. In fact, a lot of our clients who've been in a house for say 20 or 25 years, if they've refinanced a number of times, they may be in paying on that loan for 20 or 25 years. But what's happened is every time they refinance, they start out here. And so the trap is if you keep refinancing, you keep starting over at the front of the loan. You may pay on a loan for 30 years, but you're only paying the portion of the loan that's almost all interest, which works in the favor of the bank. So wouldn't it be cool if there was some way to move quickly through these, what I'll call bad years that are mostly interest, and at least get into the portion of the loan where you're starting to pay down some principal? Well, how might we do that? Then I want to pose my next question. If you and I were to interview 20 people this afternoon, just walking down the street, and asked them, said, Mr. and Ms. Jones, how many mortgage payments do you make a month? What do you think most people would say? One. My question would be, why? Who told you to make one payment a month? In fact, I'll ask you that question. Who told you to make one payment a month? See, you might have misunderstood. Your loan documents require that you pay one full payment every month, but it doesn't say anything about that's the only thing you can pay or that's the appropriate thing to pay. In fact, if you could pay 2 payments a month, the curve would look like this. You would pay the loan off in 15 years instead of 30, and you would save all of this interest that would never be paid. You with me? But you see, most people, they would look at me and say, well, Norman, pay 2 payments a month? I struggle to pay $1342.05 every month. 2 payments would be $2,684.10 a month. I can't do that. Well, when they say that, they don't understand how a mortgage works. You see, here's the deal. To make 2 payments a month, it doesn't cost $2,684.10. It only costs an extra $314.14 in the illustration I have in front of you. What? Yep. Let's say that we're on payment number 10, and by the rules of our documents, according to the deed of trust and note, we have to make one full payment every month, okay? So we're on payment number 10. We're going to pay $1342.05 as is required. But if we meet the requirements of proper prepayment, if we follow the steps of this mortgage acceleration technique, then right after we pay this payment, if we're doing everything right, we can pay an additional $313.14, which is the principal payment of the very next payment. And at that time, eliminate payment number 11 from the mortgage, saving $1,028.91. What? Yep. This is not revolving credit. This is a fixed mortgage that has an amortization associated with it. You're going to have to settle 360 payments to pay this mortgage off. Let me repeat myself. Every month you have to make one full payment. But if you do things right, and I'm going to tell you what those rules are in a minute, then you can turn around and pay the next or the next 2 or the next 3 payments, pay the exact principal amount, exact to the penny. You can take care of those payments. Or what's illustrated on the screen for you is I can take care of payment number 11 for $313.14 months. Excuse me, $313.14. Or I can wait till the beginning of the next month and pay $1342.05 to take care of exactly the same payment. And I have that option every month. Most people at this point say, what? And are scratching their head. But it's true. And let me tell you what you have to do to properly take advantage of this mortgage technique. These points are in your booklets if you printed them out, but I'm going to take the time to go over them because they're important. What I'm going to tell you is exactly what has to be done to properly prepay a mortgage and have the bank forced to do what's most favorable to you. And then we can talk about issues around that. But the first thing is you want to obtain the mortgage amortization scale from your lender. Now, you and I both can figure out all they're going to do is print out an amortization schedule from their computer, but you do want to get it from the lender. In fact, lenders are supposed to give borrowers a copy of the amortization schedule at closing. Most of them do that today, but not all of them do. The reason that you want to have the amortization schedule, the one from your lender, is because the first time they make a mistake and you go in to talk to somebody at the bank, they're going to look at your records and look at their records. And the first thing they're going to say is, oh, you used a different amortization schedule, and different amortization schedules round off differently. And that's why this doesn't balance out and cross-check. You want to be in a position of saying, oh, no, no, no. I used the amortization schedule that came with my mortgage. You gave it to me at closing, and that's the record I've used. Or you want to say, I emailed you, wrote you, asked for a copy of the amortization schedule associated with my loan. You want to do that so that you counter that argument, because that's what they're going to say is, oh, you used a different amortization schedule. Well, no, I didn't. Second rule is you want to make your regular mortgage payment before the due date. What? Yep, you're going to have to back up and pay your payments a little earlier. In fact, if I were to ask you when you make your monthly payments for mortgages, I bet you most of you would say, oh, about the 5th or about the 8th or about the 10th, because you know that the bank doesn't consider your payment for a past due penalty until the 15th. You're not penalized until the 15th. But guess what your loan documents say? Your deed of trust and notes say that your payment is due in their hands by the 1st of the month. If you pay your payment during the grace period, you don't get a late payment fee, but you're paying your mortgage late every month, and most people do. To do this technique correct, and you'll see why in a few minutes, you have to make your regular monthly payment before the due date so that they have the payment in their hands by the date that it's due, which is the 1st of the month. After you make your regular payment, and the instructions that I've always been given and always seen say you write a check. I know most people don't write checks anymore, and I'll talk about that in a minute. But if you want to be absolutely positively that it's applied correctly, these are the steps, the written steps for the accuracy of the mortgage technique. With a separate check, you pay the precise principal portion of the next mortgage payment, still in advance of the due date, but after you've made the regular payment that's required. You're going to make one full payment, and then immediately thereafter, I'm going to make a payment of the precise principal portion of the next mortgage payment or payments. Fourth item says you have to instruct the lender in writing as to the purpose of the prepayment and which payment you're prepaying. Well, Norman, this is starting to sound like a lot of trouble. Well, it is, but it's going to save you a lot of money. And here's why you have to do all these things. It might be easier for you to open your worksheet to the page that we're looking at on the screen. It might be easier for you to read it in front of you, but I'm going to read the highlighted section to you. And this is actually from my own mortgage with Bank of America. And I didn't study this until late in the game, but this is what they tell you right up front. Listen to this. A partial payment is a payment that is less than your periodic payment due. Well, there you go with a bunch of gibberish right there. Periodic payment means the full payment that's due every month. One per period is required by your loan documents. A partial payment is some money that you send in less than a full payment. That's what that first sentence means. Now listen to this. Depending on a number of factors, including the requirements of your loan documents, there you go, note and deed of trust, applicable law, and the delinquency status of your loan. If you paid it before the first, do they have the money on the first? If not, your loan's delinquent. Based on all those things, a partial payment may be returned to you. It might be applied to your loan, or it might be accepted and held in a non-interest bearing unapplied funds account for a period of time until you send us additional funds sufficient to equal a full periodic payment due. What? Yes, this is what happens very often, is that when you just send in random money, it gets put aside in a non-interest bearing account called unapplied funds, and it sits there not saving you any interest, not paying down your loan until you send in enough to equal a full payment. They're telling you right there that they have the option to do that. And no matter what you do, if it's a partial payment, they're going to apply it, first of all, to, let's see, I'm sorry, pick back up. If your periodic payments are paid current, meaning your loan is current when the periodic payment is paid, and you submit a partial payment while your loan is current, the partial payment will be applied as you instruct. That's why you have to tell them in writing what you're doing. And if not instructed, it will be applied first to fees or other amounts owed on your account, and the remainder will be applied to the principal balance of your loan if it's not put in non-interest bearing unapplied funds account. If for any reason we're unable to apply a partial payment to your loan as you instructed, we may return the payment. If your loan is not current and your loan documents permit us to hold a partial payment in a non-interest bearing account, let me read that again. If your loan is not current, meaning you didn't pay it in advance, and your loan documents allow, which they all do, we will hold the partial payment in a non-interest bearing account. We'll do so until additional funds equal to a periodic payment are sent in. If your loan is in default and declared due and payable, or your loan is in foreclosure, we may be unable to apply a partial payment to your loan and may hold it in a non-interest bearing account, unapplied funds, or return it. It's really important that you take time to read this, because most banks don't even tell you this stuff in writing, at least not in a very visible place like this. And most people never understand that this is how a loan works. But you can read right here for yourself. They're saying, if you tell us what to do, if your loan is current, if the prepayment amount is exact to the penny, then we'll do what's most favorable to you. And if you don't do all those things, we're going to do what's most favorable to us. That's what they're telling you. The next thing is you want to maintain some type of ongoing records. And it doesn't have to be complicated. It can be done just on that amortization schedule that they give you. But you do have to maintain records, because banks make mistakes. If you send checks, you can keep your canceled check as proof of lender acceptance. If you pay online, there are a couple of problems, and I know most people do pay online. Number one, you got to know that it's live online, that it's when you enter something online, it happens right then. The computer system's active and current and online. It's not recording something to be done in the future. Most banks today are live online. A few years ago, it was more common that you'd see, yes, you enter this online, but it actually gets processed later. Most of the time it's live processing, but you need to know that. And secondly, somewhere in the memo of that payment, you got to note what it's for, because it says right there in the document, you got to instruct them as to what you're doing. So you've got to either keep your canceled checks or keep a copy of what you submitted online. You can always print screen what you submitted. And the reason you got to keep a record of what you did is because the bank's going to make mistakes from time to time. Step 7 says analyze monthly mortgage payment from the lender to determine if the payments have been applied correctly. In other words, is the lender correctly accelerating your amortization schedule, your mortgage? And you have to look and check. You know, people have stopped balancing their checkbook. They've stopped checking their credit card receipts against their monthly statements. And most people, the only look that they ever give to their home mortgage is at the end of the year when they get that statement that says what their balance is. And here's how most people check their mortgage. They go, that looks about right. And that's all they do. They don't keep any records of what they paid or when they paid it. They don't have any way of knowing where they are in their mortgage. That's sort of ironic to me, because a mortgage has 100 times more dollars associated with it than a checking account or a credit card, and yet it gets the least scrutiny of all. Number 8 says contact the lender if and when mistakes occur. Now, you know, people say, oh, banks. Well, let me tell you what, banks make mistakes in checking accounts. Just talk to some people. They'll tell you they've had banks make mistakes in checking accounts. Banks make mistakes with credit cards. And guess what? They make mistakes with mortgages too. We just don't track it and don't scrutinize it. Now, remember what I said, your deed of trust requires that you make one full payment every month. But by prepaying principal of additional payments, you're shortening the term of your mortgage loan. You're saving interest that you're never going to have to pay. Now, if you're a check writer, if you still write checks, you can use the form letters that I'm getting ready to go over. You could create an easy template in Word that you use every month. Or if you use the online bank's payment feature, try it and make sure that the money gets applied correctly as you intended, and still keep a payment record in case they do make mistakes. So let's see how this would work. Let's go back to our original loan. Let's say we did make payment number 10, and that's all we did was pay payment number 10. So now June's coming up. It's going to be June. Actually, I did this last year, so I'm 1 year behind. But June of 22, I put the month on the left and the year on the right. This is my tracking system. This is all I need. This is good enough as long as I'm doing it on the amortization schedule, the one the bank gave me. I have to, by rule, pay one full payment, and I'm going to do that on 6/22. And then I'm going to look down and see that in order to take care of payment number 12, I would have to send in an additional $314.45. I can do that. And the instructions said to do it with a separate check. If you're doing it electronically, you would process the $1342.05, get that recorded, and then immediately turn around and send in an additional $1314.45. The reason it's important that it's exact to the penny is this. Those mortgage payments don't go through the mail or electronically to the president of the bank. He doesn't walk over to the controller and say, oh my goodness, Jeff just paid his mortgage payment this month. Looky, yay, good, record this correctly. That's not how it happens. Payments get processed in the middle of the night in the basement, by minimum wage workers that have had very little training. And what happens if you pay exactly the right amount, exact to the penny, that matches what's on their little computer screen, and boom, it goes forward just like you would want it to. If it's not the exact amount, exact to the penny, they don't know what to do. And another button gets hit and it goes over here in unassigned funds to be reviewed sometime in the future by somebody else because they didn't know what to do with it. So being exact is very important. Now, how would I keep a record? This is a little template that I use personally for a long time. Again, I realize most people pay electronically today, but if you want to know absolutely positively that you're covered, the written instructions say send in a check. So I'm telling them ABC Mortgage encloses my check 121 in the amount of $1342.05 as the monthly payment for the month of June, and it pays all interest and principal due for payment 11. I just told them what payment I'm paying and what month it's for. And then the second paragraph says also encloses a second check, my check number 122, drawn in the amount of $314.45 as prepayment in full of the principal amount of the following payments. And I left myself room to do one or more. This month, I'm only doing one. And so I'm sending these written instructions with 2 checks, and I'm mailing it in time for it to be at the bank before the payment is due on the 1st. Now, if you're going to do electronic, again, you need to test it out and make sure it'll work with your bank. But you do the same thing. You make a payment, and in the memo, when you pay that full payment, you say payment number 11, June 2022. And then when you make the second payment, you say prepayment of payment number 12, 1314.45. So the old method is going to have a better record, but I realize most people don't do that. If you're not going to keep a written record of what you mail in and your canceled checks, at least print for yourself what you do online, which again, you can easily do by hitting print screen. So that takes us to July. And now I can look at my AM schedule and say I'm on payment 13 and it's July. I have to make at least one payment every month. So I'm going to pay $1342.05 in July of 22. And I look down, and to take care of the principal payment of payment 14 would cost me $317.07. So I'm going to make a second payment of exact that amount. And when I do, I'm going to eliminate $1,024.98 from my mortgage. How about that? Well, let's do it. We're going to do the same thing. Closes my check 137 for $1342.05 as my payment for July. It's payment 13. Also encloses my check 138 for $317.07 as prepayment in full of the principal amount of payment 14, blah, blah, blah. And when we go back to the mortgage table, to our AM schedule, the way you know that the bank is doing it correctly and applying it correctly is if your principal balance matches what's on your AM schedule. If it matches, and after I make these 2 payments, I check in a couple of days and my balance is $245,678.76, then I know it's being applied correctly. If it doesn't match, then there's a problem somewhere and I've got to talk to the bank. Now we're to August and I'm down on payment 15 and I just got a commission. So I've got the money to pay my required full payment, but I think I could pay another $1,000 down on the loan. But because I've had this little session, I know I don't want to just send in $1,000 or send in $500. What I want to do is look at the next payments and say, okay, well, if I made the next 3 payments, I can cover those, but I need to pay them exact to the penny. Well, how do I do that? Well, I send in a regular payment, just like we said, $1342.05. Then with the second payment, I'm going to prepay the principal amounts exact to the penny of payment 16, 17, and 18. It comes to $981.66. I've told them exactly what I'm doing. So again, if I'm using electronics, I've got to enter the payment of $981.66, but somewhere on the memo, I got to say prepayment principal of payment 16, 17, and 18. Again, I like the written record better, but I know a lot of people won't do it. So where are we? We've been paying on this mortgage since we've been talking for 3 months. But we have eliminated 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7, 8 payments from our mortgage. We've been doing this for 3 months and we've eliminated 8 payments, and we've eliminated over $5,000 in interest that we will never have to pay. That's sort of mind-blowing, isn't it? What we're saying is we're moving more rapidly through those years or months that are mostly all interest, getting further into the loan where we begin to kill off some mortgage. Now, admittedly, if you go back and look at your amortization schedule, over time, that principal amount's going to get bigger. So if you really wanted to kill this thing off in 5 years or 10 years or 15 years, what you do is you start out in the early years and pay more than one prepayment while they're low and easy to do. In the middle 5 years, maybe you pay just one, and then maybe the last 5 years, you can't prepay. But it's very feasible to pay a loan off in 15 years instead of 30 once you realize there's no rule about paying one payment a month. You can make as many payments as you want to. In fact, I've seen people that got an inheritance or an unusually big commission sit down and scroll down their amortization schedule and pay 20 payments at one time by paying the exact principal amount. You start thinking about this and lots of things are possible. In fact, I had a lady one time call me up and said, "I'm mad at you." And I said, "Why?" And she said, "Well, I'm remodeling my kitchen and I listened to what you said about mortgage acceleration. I was going to buy this fancy refrigerator that costs $4,000. And I looked at my amortization schedule and realized how many payments I could prepay. And now I got a hole in my kitchen." Well, I don't want you to carry it to that extreme, but it is exciting once you start something like this to see how quickly you can move down that amortization schedule and how quickly you can pay for the mortgage. So let's do an example. Let's just play with this one more time. You can do it for yourself now, or you can save this and do it later. But I've posed a hypothetical example. Let's say we purchased a single family home for $275,000 plus $3,500 in closing costs. And we borrowed 80% of the purchase price at 4.25%. And then I'm giving you some specifics here. This is printed, so you have it in your book. You can have it in front of you. It says when you make payment 5, you pay principal for payment 6 and 7. When you pay payment 9, you pay principal for 10, 11, 12. When you pay 15, you pay 16, 17, and 18. Let's figure out how much principal we paid, how much interest was avoided, and what the outstanding loan balance should be after payment 18. If you have that amortization schedule generator, you can print one up. Again, if you just send me a quick email, I'll send it back if you don't have it in your repertoire. But let's look and see what happens. If we do what we said, and when we make payment number 6, let me get my words. When we pay payment number 5, we prepay payments number 6 and 7. There they are right there. And when we pay payment number 9, we pay 10, 11, and 12. And when we pay 15, we prepay 16, 17, and 18. what you'll see is that the extra principal that we paid over this time is $2,500, but we've saved over $6,000 in interest never to be paid. Now, here's the problem. What if we just did this the old-fashioned way? What if we just went back and randomly sent in money from time to time when we could? Well, the problem is, number one, we never know where we are in the mortgage, so we don't have a way to keep track of the bank and make sure they're doing it correctly. But secondly, we don't know where they applied the payment. What do you mean, Norm? Let's say this is the loan we're working with, and we just send in a random $500. Well, did the bank apply it up here where it works to my benefit and saves me the most interest? Or did they apply it to the last payment, which means when I make the last payment of the mortgage, instead of being $1,342.05, it'll be $842.05. That would be in their favor. Banks are not going to cheat you. I'm not saying banks are dishonest, but think about it. If you and I were bankers and we had a choice, would we apply it to the last payment that saves our customer a few pennies in interest, lets us keep most of our profit, or would we apply it up here where it's most favorable to them and cuts us out of making a big profit on those payments? Well, banks are in business to make money. They're going to do what's most favorable to them unless we do the things that they require us to do in order to do it most favorably to us. I encourage you to go back and read this paragraph again, and you'll understand that what they're saying is, if you follow the rules and jump through all these hoops, we'll do it in the way that's most favorable to you. But if you don't, we've got the right to do what's most favorable to us. And I'll tell you, banks are going to do what's most favorable to them. They're in business to make money, and they're in business to make a profit. Every time I go through this, somebody in the crowd says, well, I think you're wrong, Norman. It doesn't matter where your principal is applied. Well, if you think that, let me do this. We'll each make a payment of $1,342.05. I'm going to make this payment, and you make this early payment. And you get to keep the principal associated with this payment, and I get to keep the principal paid with this payment. Now you think through that. Does it matter where your payment is applied? Absolutely. Payments later in the mortgage are different than payments earlier in the mortgage because we're not dealing with revolving credit. We're dealing with a fixed amortization schedule and a self-amortizing fixed rate level payment, self-amortizing mortgage loan. And that's really what the trick is. It's not magic. It's the nature of the loan. The loan has associated with it 360 specific payments. Each payment has a set amount of interest and principal applied to it. And you have the right to make as many payments a month as you want to. If you do it the right way, following all those instructions, the bank's going to apply it in the way that's most favorable to you, which is to apply it to the very next payment that eliminates the interest from the mortgage. The reason that it eliminates the interest is you paid that principal in advance. The interest had not accrued yet. It was never due. It's not a trick. It's not magic. It's just how the math works. So at that point, I'm going to stop and let you unmute yourselves and ask some questions.